Inventory sits at the intersection of the balance sheet and income statement, and how a company accounts for it changes both its reported profit and its reported assets, which is exactly why the exam spends real time here. There are two main methods you need cold: FIFO, first in, first out, which assumes the oldest inventory costs are the first ones expensed as cost of goods sold, and weighted average cost, which blends all inventory costs together into a single average. USGAAP also permits LIFO, last in, first out, assuming the newest costs are expensed first, but IFRS does not allow LIFO at all. This difference alone is a favorite exam trap. If a scenario mentions a company using LIFO, you should immediately know it's a USGAAP reporter since IFRS forbids it. Here's the intuition for why the method choice matters, especially in a period of rising prices, which is the scenario the exam tests most. Under FIFO, the oldest, cheaper costs get expensed first. So cost of goods sold is lower, meaning gross profit and net income are higher, and the inventory left on the balance sheet reflects more recent, higher hard costs. So inventory value looks higher too. Under LIFO, it's the reverse. The newest, more expensive, costs get expensed first, so cost of goods sold is higher, net income is lower, and the leftover inventory on the balance sheet reflects older, cheaper costs, understating its value relative to current prices. So in rising prices, FIFO gives you higher net income and higher inventory value. LIFO gives you lower net income, lower inventory value, but because less taxable income is reported, typically lower taxes and higher actual cash flow. That's the paradox worth remembering. LIFO looks worse on the income statement, but can actually leave the company with more cash because of the tax effect. Recap. FIFO expenses oldest costs first. Weighted average blends everything. LIFO expenses newest costs first and is GAAP-only. In rising prices, FIFO means higher net income and higher inventory value. LIFO means lower net income, but often higher actual cash flow due to lower taxes. Next, long-term assets.